So I would name just two challenges. One is clearly the challenges out of the energy transition and how we get to a net zero economy. And we need to develop the right financing tools and structures for this really broad sector of infrastructure. What I mean by that is there are certain new technologies where we would probably need to develop certain blended finance structures in conjunction with multilaterals and other sovereign support, government support, to take out certain risks which in today's market you can't price. In terms of liquidity in the energy transition, there is a lot of liquidity. A lot of investors want to participate, but we also need to have the right incentives. The right incentives, I mean that investors are able to finance borrowers which are, let's say, using coal as an example, but convert to renewable energy, and therefore helping to actually convert the economy towards a net zero. That's important to have these KPIs in the structures. The second challenge, I would say, comes out of the interest rate, the rise of interest rates. Clearly, because all our companies are effectively also financed with debt, and debt has become so much more expensive, the buyers of companies right now expect a lower price if they want to buy a company, because they have to pay more to finance those purchases. But the sellers of those companies, they expect still the kind of old valuations. And so there's a disconnect in the market where buyers and sellers, they don't speak the same language. And this has to align itself, and hopefully this will happen at some point. Also, the higher interest rate environment has taken some liquidity out of, let's say, the traditional finances of infrastructure, and to name a few insurance companies and pension funds, who are already participating in private markets, but who are now over-allocated in private markets because the public markets have declined in value significantly due to the interest rates increase.